Good afternoon, everyone. My name is Alana Brown, and I'm here with you from solo401k.com and Nabers Group. Today is our Webinar Wednesday series. We will be discussing the Roth 401k. So very exciting. It's great to have you guys here. If you could do me a favor, let me know over there. Can you see me? Can you hear me? Like always, we like to tell you the different ways to get support. So the 3 different ways to get support from us when it's not business hours or we're not doing a webinar is our network, which is solo401k.net. It's a great place to ask questions, gain knowledge, and connect with like-minded investors. Also, our website, solo401k.com. It's like having your own personal library. Get the knowledge you need immediately. Find other resources such as calculators, blog posts. And last but not least is our knowledge base, which is support.solo401k.com. You'll find all kinds of rules, guides on how to set up various brokerage accounts, bank accounts, cryptocurrency exchanges. So these 3 resources, they're available 24 hours a day. So absolutely check them out. All right. Well, hello to Brian, Bev, Doug, Dave, Chad, Jerry, John, Philippe, everyone. Hello, hello. Wonderful. Thank you, thank you, thank you. Okay, so we will jump in. As I'm going through the presentation, if you have any questions, right down there, ask a question. So we'll go through the slideshow. I'm gonna draw some boxes back there, and then we'll take any questions that you guys have. So let's jump in. The Roth 401k, tax-free growth. Quick disclaimer, like always, we are not the replacements for your CPAs, your tax advisors, your legal counsel. We are your IRS plan document providers. We're also here to provide you with education, support, and great resources. A little bit about us. We launched the IRA LLC in 2003 and solo401k.com in 2006. We've been doing this for many years. We love it. Happy to do it. Always compliant with the IRS. What's really great is all of us here, us team members, we all have our own checkbook control plans. We know how to use them. We know how to help you. So today, we're going to cover the ins and outs of the Roth 401k. A lot of people may not know that your solo 401k comes with a Roth 401k. So you can make, new Roth 401k contributions and also traditional contributions. So we're going to discuss how you put these funds into the Roth 401k, how you can get even more funds than you would ever think is possible. And then, of course, some paperwork to consider. Let's talk about Roth 401k rollovers. So there's no tax implications if you're rolling over any previous 401ks, Roth, 403bs, or 457 Roths. This is the IRS rollover chart. What's really important to take a look at here, look at the Roth IRA. The Roth IRA does not roll into anything but another Roth IRA. So a lot of people ask, can I roll my Roth IRA funds into the Roth 401k bucket? You cannot. So that's a no, 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 no. You can roll your Roth 401k out to your Roth IRA though. I'll give you guys a few seconds to check out this rollover chart. Very helpful. You could also find it on the IRS website. All right, let's talk a little bit about contributions. We've chatted about this many times here on our webinars. Like, there's two ways to get funds into your solo 401k. It's rollovers and contributions. Your contributions are always based on your net compensation. Your contributions can be pre-tax or after-tax. Let's do a little refresher on the different types of contributions. You have your employee salary deferrals. That can be up to 100% of your compensation, maxing out at $19,500. These contributions, they can be pre-tax or Roth. You're going to decide. Then there's the employer profit sharing contribution. That's going to be 20 to 25% of your net profits. If you are a sole proprietor or a single member LLC, it's going to be 20% of your net earned income. S corps, C corps, partnerships, it's going to be 25% of your W-2 wages. These are going to be pre-tax only. Pre-tax contributions, they're made with pre-tax dollars. So these are tax deductible. So you'll be able to lower your income with your pre-tax contributions. You will be paying taxes when it is time to distribute. But the whole idea is that your tax rate is going to be lower upon distributions. Okay, so should you be making pre-tax or Roth contributions? That's up to you. It's a very personal decision. It's something to discuss, with your family, with your financial advisor. Some things to think about. What is more important? Do you want to reduce your taxes now? Or do you want to pay no taxes later? Do you want to do a combination of both? There's no right answer to this. This all depends on you. And every year your strategy can change. So talk to your family, talk to your CPA, your accountant, talk to your dog, talk to anyone that's a big part of your life. So like we went over, there's that employee salary deferral. That's going to be the pre-tax or Roth. And you can do $19,500. And then if you're over 50, you do have that $6,500 catch up. And then the employer profit sharing, which is either 20 to 25%. There's no catch up on that side. Okay, so we're going to focus on employee contributions because that's how you can contribute to the Roth bucket of your solo 401k. So the government, they wanted to, create something similar to the Roth IRA, but in a 401k version, which is great. It was the Economic Growth and Tax Relief Reconciliation Act of 2001, the EGTRRA. It's a mouthful. This is where it all started. So Roth 401k funds, they are after-tax dollars. You're not going to get that tax deduction, but all of the growth, the gains, that is all tax-free upon distributions. What are some of the benefits here? So I know many of you out there, you're making too much money, which is great. But you can't contribute to a Roth IRA. There's no income ceiling for the Roth 401k. So now you have the chance to make these Roth 401k contributions. So that's why this is very, very attractive to some of you high earners out there. Like we said, there's two kinds of contributions, the employee and employer. Only those employee contributions can be Roth 401k contributions. Contributions are tricky. That's why I'm just repeating myself. Once again, those you see your employee and the employer, and it's those employee contributions that can be designated as Roth. So what are the limits? Like we said, it's that $19,500 is for this year, 2021. You can contribute all of that, part of it. Let's take a look at Tiffany. So Tiffany, she's a 45-year-old doctor and is the only employee of her S Corp. She pays herself $120,000 in W-2 wages. Remember, she's an S Corp. She has to pay herself W-2 wages. That's how she's going to base her contributions. And we know she qualifies because she's the only member of her business, the only employee, the only one getting those W-2 wages. So if she's getting $120,000 in W-2 wages, her max contribution is $49,500. So you see the employee contribution of that max of $19,500 because she's under 50 years old. And then you have the employer contribution, which is 25% of the $120,000, which gives you $30,000. So Tiffany wants to put all of her employee contributions as Roth. So what she'll do is she'll just deposit that $19,500 right into the Roth bucket of her trust checking account. Pretty simple. I'm sure many of you are familiar with our contribution calculator. It's a phenomenal tool. You can see Tiffany's information here. If you guys have not checked out the contribution calculator, you absolutely should. Of course, with contributions, you want to double check everything with your CPA. Contributions are tricky. If you hit View Report, it gives you a breakdown of your different contributions and your income. You can see here, there's the $120,000 of the income. There's the employer contribution. That elective deferral amount, which is the employee, she does not get catch-up. So you can see the whole breakdown here. I know you can see the breakdown of like a SEP IRA, a simple IRA, the profit sharing. It's just comparing. You can just see how much more you can contribute in the solo 401k. Like we've gone over for 2021, the maximum for your Roth 401k contribution is $19,500. And then the catch up for this year is $6,500. But wait, you can actually get more funds into your Roth bucket. You were thinking that you were, maxed out at that $19,500 or that $26,000. You're not. So we've gone over Roth 401k contributions, but now we're going to talk about some other capabilities you have in your plan. There's voluntary after-tax contributions, the mega backdoor Roth, and in-plan conversions. Let's talk a little bit about voluntary after-tax contributions. I'm sure a lot of you out there don't even know that this exists. Most people don't. And guess what? Our plan allows for this. Not all solo 401k providers allow for this voluntary after-tax contributions. If you're not a current client of ours, maybe you have a solo 401k at Schwab or Fidelity, you're not allowed to do these. We have a lot of people that restate their plan and come to us because our plan allows for this. So voluntary after-tax contributions, it's a type of employee contribution. It's not tax deductible. You can contribute up to $100,000 of your net compensation. So that means for 2021, you can contribute $58,000. Or if you're over 50, you can do $64,500. What's really important is if you max out that $58,000 all on your voluntary after tax, you can't make any more contributions. That $58,000 is your total contributions for the entire plan. Of course, you can do a mix of what you want. You know, you can do some of the pre-tax or Roth, your employee or employer, or all voluntary after tax. It's up to you. Remember, you're talking to your CPA. You guys are discussing your strategy. So let's dig a little deeper. So the voluntary after-tax contributions, they don't start out as Roth. When you're making those contributions, they will actually be taxable. So that's why you need to do an in-plan conversion. You're actually going to make these after-tax contributions and you're going to move it over to the Roth portion because you don't want to pay the taxes on the growth. Not all plans allow for in-plan conversions. So luckily, you get all of these capabilities with our plan. So as you can see, you would just convert the voluntary after-tax contributions to the Roth bucket. And we'll go over that a little deeper. And I'll also draw some boxes and arrows so it makes a little more sense. But this is a way, to get $58,000 into your Roth 401k. So we just jumped from $19,500 to $58,000. It's pretty incredible. So let's go back to Tiffany's example. Her W-2 wages were $120,000. Her max contribution is $49,500. For the employee contribution, it's $19,500, and the employer is $30,000. So Tiffany's making all of her, employee contribution into her Roth 401k. She only needs to lower her taxable income by $10,000. So she's going to take $10,000 from her employer profit sharing, and she'll make that contribution, which is pre-tax. So she's lowering her taxable income by $10,000. Now she wants to take the remainder and make that as voluntary after-tax contributions. So she can put in $20,000. What's the breakdown? It's at $49,500 of her max contribution minus she made that employee contribution of $19,500 and she made her employer contribution of $10,000. That leaves her with her $20,000 that she made to her voluntary after-tax bucket. She did her in-plan conversion, and now she's got that $20,000 in her Roth 401k. Tiffany now has $39,500 in the Roth 401k bucket. So instead of just that $19,500, she essentially doubled her Roth funds. So, she wanted to do this because she wants to invest in cryptocurrency, maybe some angel investing. And why it's important to her, she doesn't want to pay the taxes on those gains. It might be some pretty extraordinary gains. So her thought process is that she'll want to make those investments with her Roth funds. Of course, She spoke to her tax professional. They gave her the A-OK, and they worked together on what her plan is. We're going to touch a little bit about the mega backdoor Roth. A lot of people are interested in this. So it allows you to contribute more after-tax dollars than you would be able to in a normal, Roth IRA or 401k structure. It's another way to get more funds into that Roth bucket. Of course, you're doing conversions. You're utilizing the things that we've discussed, the voluntary after-tax contributions, in-plan conversions. The mega backdoor Roth, it is a very complex strategy. You want to work with your CPA. What is important for you to know is that our plan, Nabers Group Solo 401k plan, allows for all elements of the mega backdoor Roth. Work with your CPA, get those funds into your Roth, and you can actually move it out to a Roth IRA. We're going to do a webinar dedicated solely on the mega backdoor Roth, so stay tuned. Let's talk about in-plan Roth conversions. This is how you're going to take those non-Roth funds and you are going to convert them into Roth 401k funds. Conversions are up to you. You can convert everything, a piece. You can convert traditional funds or those voluntary after-tax non-Roth funds. So you have some options. Maybe you've been making lots of traditional contributions because that's what's been important. You're making too much money. You need to lower that taxable income. So that's what you've been doing. But now you feel like, I want some more Roth funds. You can absolutely start converting some of those pre-tax traditional funds to Roth. So as you can see, you have the ability to convert what you want. Always important to work with your CPA because you might be paying some taxes. It depends on what you're converting. The 3 steps to complete an in-plan Roth conversion, fairly simple. Decide how much to convert, move the funds over, complete your paperwork, and of course, you want to pay the taxes if they do apply. When you're deciding how much to convert, you absolutely want to talk to your tax advisor. If you're going from pre-tax, those traditional funds, to Roth, you're paying taxes. Like I said a little earlier, you can decide how much to convert. It's up to you and your tax professional. A lot of people will wait until maybe they had a lower income year. It's what works best for you. You can do conversions over time. Bite the bullet, do it all at once. It's up to you. And that's what's great about this. You have that flexibility to do them when you want, based on what's best for you. Fairly simple. Once you've decided on how much you're going to convert, you're just going to wire the funds from, that bank account, whether it's a traditional or the voluntary after tax or the brokerage, to your Roth bank account or brokerage. It'll look like this. Whoop. Fairly simple. Paperwork. I know we all don't love paperwork, but we also know it's a very necessary part of our solo 401ks. So we have in-plan Roth conversion forms that you can utilize when you're doing this. You're going to find it in your zip file. You probably already have that downloaded on your computer. If you don't, it's on your dashboard under the zip file. This is what the in-plan Roth conversion form looks like. You'll want to fill it out each time you do a conversion. That first part is your information. You're the employee. So you're going to put all of your information there. For the second part, what kind of funds are you rolling over? So you'll select that. Just so you guys know, it doesn't say on this form voluntary after tax, and I'm sure a lot of you are going to convert some of those. You can edit this form. So when you open it up, you can, in your Adobe, just click on edit and, add a box or print it out and draw it in. You can absolutely edit these forms. So if you need to add that voluntary after tax box, go for it. Part 3, how much are you converting? And then of course, the last part, the last 2 parts, remember you're the participant and you're the plan administrator. So you're going to sign on both those lines. Once again, you'll find this in your zip file. You don't need to send us a copy of your in-plan conversion. You never need to send us anything. You are your own plan administrator. So keep it in a safe spot. Share it with your tax professional. Okay, let's talk a little bit about Form 1099-R. This comes up a lot. Maybe you guys have done some rollovers. You got a 1099-R. So it's really important. This is a big part of doing these conversions. If you're moving from pre-tax to Roth, after tax to Roth, anytime funds are moving, you need to do this 1099-R, even if the conversion is not taxable, because you're not going to pay taxes on that voluntary after-tax conversion into a Roth 401k, but you still need to document. Very, very, very important. There's some rules on how to file this form. So it cannot be filed with a PDF file. Only approved filers can submit the 1099-R. Your tax professional is most likely an approved filer. I would hope so. If not, we have some great tax professionals you can talk to. Also, of course, that we have some resources because that's what we do. If you go to support.solo401k.com, type in 1099-R. These are just 2 examples of some of the resources that we have. There's probably like 5 to 10. We actually also list websites where you can do your 1099-R on your own. So pretty cool. I think it costs $3, $4. Of course, if you don't feel comfortable doing it on your own, talk to your CPA. So check out our knowledge base. We have a ton of things about that 1099-R. Some deadlines. Make sure you furnish a copy of the form to yourself by July 31st. The IRS needs their copy by February 28th, or the e-file by April 1st. Your CPA should be able to help you with these deadlines, but always important to keep them in the back of your head as well. There are late penalty fees. Of course there are. The IRS is allowed to be late for stuff for us, but we cannot be late when they ask us to file a certain thing. So make sure you're doing everything on time. You don't want to have to pay late fees. Paying taxes on the conversions. So we've touched upon this a little bit. Remember, if you're converting from those after-tax, the non-Roth, those are those voluntary after-tax contributions, you're moving that to your Roth bucket. Yes, you're doing that 1099. No, you're not paying any taxes. You are going to pay taxes if you're converting from the traditional to the Roth. Remember, if you don't convert those after-tax contributions to Roth, you're going to pay taxes on the growth. So you may not want to leave it in that bucket. You're not going to get the benefits that, you initially wanted. Move those funds over. Logistics. So you can do all of this with a brokerage. It's a little easier maybe with a bank account, but remember, this is your solo 401k. You decide how you want to do it. But we're going to talk about bank accounts. So you'll have 3 bank accounts. Remember, the bank doesn't care what these funds are. You do. Because it's just a checking account in the name of your trust. You're the one that's nicknaming these accounts. You have your pre-tax bucket, your Roth bucket, your after-tax non-Roth. Those are those voluntary after-tax. Go into settings, nickname your various accounts. If you go with one of our recommended banks, Solera or Titan, they'll nickname them for you. So they're just sub-accounts. They're all within your plan. And remember, we're just keeping these funds separate. Here's your different bank accounts, all under your solo 401k umbrella. So, like we've talked about a million times, we suggest these things because it makes your life easier. So having these distinct bank accounts for the separate tax classifications make you, as the plan administrator, the record keeper, it makes things much simpler for you. So you want to keep these traditional, these Roth, these voluntary after-tax contributions separate. It also makes it much easier for you to do your in-plan conversions, your mega backdoor Roth. You guys know it. I've said it. You are the plan administrator. You're keeping those great records. When is money coming in to the account? When is it going out? Which bucket is it in? Having a spreadsheet. I have a spreadsheet. On my spreadsheet, I write when I do contributions. I did an in-plan conversion. That's on my spreadsheet. It's also a reminder to me. So I need to make sure my CPA is going to help me with my 1099-R. So, keep these records. Very, very, very important. Of course, you want to work with your tax professional. I know we say it a lot. It must be very important. Okay, so what can you invest in with your Roth 401k funds? If you're allowed to, buy something with your solo 401k, you can do it with your Roth funds. So real estate, crypto, your brokerage, private lending, everything that's allowable. People choose to use their Roth for different kinds of, assets. Maybe something that's going to, have a very high return. Because remember, you're not paying any taxes upon the distributions. So we see it a lot, cryptocurrency and investing in startup businesses. But like always, we don't give out investment advice. We just provide you with some education, some examples. I like to do my crypto with my Roth funds. That's just an example. So like always, this is something you're discussing with your financial specialist, with your family. A little recap. So just like with the solo 401k at its entirety, there are 2 ways to fund. So specifically for the Roth 401k, of course, rollovers, new contributions. The Roth 401k can only receive the employee salary deferral contributions. That max is $19,500 if you're under 50. And remember, we're keeping separate bank accounts to make life easier on you as the plan administrator. Remember some rollovers that you can do that aren't going to, trigger any taxes? Roth 403Bs, designated Roth TSPs, and funds that started out as non-Roth funds, they can become Roth funds. Doing the in-plan conversions. You're allowed to convert pre-tax funds to Roth. Like we said, it's taxable, but absolutely allowable. The voluntary after-tax contributions, something you may have thought doesn't exist. It exists. Your plan allows for it. It is an awesome way to just increase those Roth funds dramatically. Remember, you can get $58,000 into there. So cool. Just a great strategy if your goal is to increase those Roth 401k funds. And we're keeping separate bank accounts for everything. The importance of documenting your conversions. We discussed the in-plan Roth conversion form, which is in your zip file. We also discussed that 1099-R. Find more information at support.solo401k.com. And we're filing this even if it wasn't a taxable event. Reminder, you want that form done by July 31st. A few questions that I think may be on some of your minds. So we discussed the first one. Can I roll over a Roth IRA into the Roth 401k? No, you can't. But maybe you have substantial Roth IRA funds. Good news, we do offer a self-directed Roth IRA. It operates completely outside of your solo 401k. But guess what? You're not stuck to just maybe the brokerage account you have with your Roth IRA. You can invest in cryptocurrency, real estate, all the good stuff that you're investing in right now with your solo 401k. You can do with this self-directed Roth IRA. So just to recap, no, the Roth IRA is not rolling into the Roth 401k. Can I mix Roth and pre-tax funds in one investment? You can. It's not recommended, but you're allowed to. But what are you doing? You're keeping extremely, extremely detailed records. And the percentages need to match up. So if like 20% of the funds came from Roth, when you're getting any return, 20% of the return is going back into the Roth bucket. Details, details, details. Another great question is, can I do an in-plan Roth conversion of an asset? You can, absolutely. This is something you want to work with an attorney, your CPA, because you need to get, the fair market value on your asset. And so there's a few more steps, but could be very much worth it. Discuss that with your CPA. Just a reminder, the 3 different ways to get support from us. That is me. If you want to jot down my contact information, if you're not a client yet and you want to chat on the phone, go to solo401k.com/consult. We can chat. I'll give you a full 30 minutes. We can go over your whole situation, decide what plan is right for you. I love chatting on the phone, so book an appointment. Okay, we're going to draw some boxes and arrows. Okay, let's adjust some things. And after this, we will jump onto your questions. Okay. That's the plan that we've provided for you. Remember, you could have various accounts under that umbrella. You're the one that's deciding. So let's focus on the bank accounts, how they're structured. So we discussed having 3 bank accounts. You have your 3 bank accounts. Your pre-tax, which is your traditional, which you might be putting some employee or employer contributions into there. Your voluntary after-tax bucket. These are considered employee only. And then the Roth, which is going to be your employee contributions as well. So you could put your funds directly into these accounts. Funds go into these various accounts. And then remember, you can do your conversions. So you want to always convert these into the Roth, or you're going to pay the taxes on the growth year. You're converting that. And then what are you doing? You're doing your in-plan conversion form. You're doing a 1099-R. Remember, you can convert pre-tax funds. Like we were discussing, maybe you've been doing lots of traditional contributions. You needed to get that taxable income down, but now you want to do some conversions. These funds can go directly into the Roth bucket. You're paying the taxes. You're working with your CPA. You're doing your in-plan conversion forms. You're doing your 1099-R. So that's the flow of it. These can be brokerage accounts as well. I know a lot of people do that. So you'll need 3 accounts, but it's the same. You always want these 3 accounts. So that's what it looks like with some boxes and arrows. Simpler than you would expect. And your plan allows for all of this. So you might as well utilize it. Let's take some questions. So the first question is from Yun Hee. Also, would you explain in detail what is a non-Roth after-tax bank account? Yes, Yun Hee. That is going to be the voluntary. It's your voluntary after bucket, the non-Roth. And remember, you're the one that's nicknaming these bank accounts. So it doesn't matter to the bank. You're the plan administrator. You're nicknaming that. It's just one of your trust checking accounts. Because remember, you could have as many accounts as you want. So you're going to want 3 if you're going to utilize these strategies. And you're keeping your pre-tax, your voluntary after tax, and your Roth separate. Thank you, Yun Hee. The next question is from Martin. Will you share the slides with us? I'm pretty sure we can do that. And also, just so you guys know, you can review this webinar on our network. So check it out. Question from Yun Hee. Is the Mega Backdoor Roth a different bucket than the Roth 401k? So I would have a traditional before tax bucket, a Roth 401k bucket, and a Mega Backdoor account bucket. Great question. So you don't need a bank account for the Mega Backdoor Roth bucket. In order to complete the strategy, you need the various accounts here. So if you're doing the Mega Backdoor Roth, you're most likely doing these voluntary after-tax contributions. So you're just going to make your contribution right to the voluntary after-tax bucket. Then you're going to move it over to your Roth. And you might be moving it out to a Roth IRA. So maybe you have a self-directed Roth IRA with us, and you're moving it out there. Maybe you have a Roth IRA, at Merrill Lynch or Fidelity. Let's say it's down here. This is not in your solo 401k. It's outside of your solo 401k. But you can absolutely roll your funds from that Roth 401k into your Roth IRA. There's different reasons why people do this. One thing is the Roth IRA doesn't have RMDs, your required minimum distributions. The Roth 401k does. So to avoid that, some people will move it out. So different reasons why to do this, but that's how you're going to do your mega backdoor Roth. You don't need a bank account like specifically called the mega backdoor Roth. Another excellent question. So thank you, Yunhee. The next question is from G. Will you be discussing valuing and converting non-cash assets to Roth? If not today, can you do that in a future session? Yes, I'm sure we can. It's something that you definitely want to work with your CPA because it does take putting a value on those assets. But yeah, I'll put that in our notes and maybe we can get someone that specializes in that on. So thank you, G. We'll take note of that. When is the 1099-R due? And do you need to file for the initial conversion of the IRA to the 401k non-Roth? So that 1099-R is due at the end of January. Do you need to file for the initial conversion of the IRA to the 401k? Not sure of your question there, Jeff. But something that I will tell you guys, if you did any rollovers of traditional IRAs into your solo 401k, the releasing custodian on that IRA is going to generate the 1099-R for you. So you actually don't have to worry about doing that. You have to worry about doing it when it's within your plan. So the good news is they'll take care of that for you. You do want to look at it, make sure it says $0 on taxes owed. Jeff, I'm not sure if I got your question there. If not, please let me know. For Yunhee, why do I need a non-Roth after-tax bucket account? So you'll need that if you're going to utilize voluntary after-tax contributions, if you're going to utilize the mega backdoor Roth. So you need, either 2 or 3 accounts. If you're not going to do traditional, then you don't need that to utilize the strategy. So, but if you're going to utilize the mega backdoor Roth or that voluntary after-tax, you do need your non-Roth or your voluntary after-tax bucket. Remember, this is going to make things easier on you as the plan administrator. Another question from Yunhee. If I open a non-Roth after-tax bucket account, does paying taxes work the same from rolling over from traditional bucket as when doing it to the Roth 401k? So if you're going from here, the voluntary after-tax, to the Roth bucket, you're not paying any taxes. You're still doing your 1099-R, but you're not paying any taxes. If you're going from your pre-tax or the traditional bucket and you're going to your Roth, you're paying the taxes on that. Hopefully that cleared that question up. Question from Martin. If I reach the maximum employee contribution, $19,500, with my regular W-2 job, can I still contribute to the voluntary after-tax contribution? Yes, you can. And this is a great reason to utilize that bucket. So awesome. Because remember, guys, if you're maxing out at a plan at your full-time W-2 job for the employee portion, then you have no employee portion left for your solo 401k, which means how do you make Roth contributions? Martin, that's exactly how. So thank you for asking that question. Yes, 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 you can make your voluntary after-tax contributions. Question from Mark. This might be outside the scope of this webinar, but let's say you buy Bitcoin with your Roth held exchange, such as Bittrex account. Can you then swap the Bitcoin with other crypto coins outside of that exchange? Or would that trigger a tax? If everything's within your Roth bucket, you can buy and sell as you want. I don't think that it would, but I'm not sure. So you'll want to double check, or you know what? Post it to our network, solo401k.net. But remember, if it's within your solo 401k, okay. Well, and so remember, if it's in your solo 401k, if you have, an account at Kraken in your trust name, buy and sell as you want. It's your Roth funds. You can buy, sell. You're not paying taxes. You're just not pulling that into personal funds. And then Mark, okay, Uniswap doesn't have any accounts. Oh, yeah. So not sure there, Mark. So Yunhee, thank you for the clarification. You're talking about going from the traditional bucket to putting money into a non-Roth after-tax bucket. How do I fund this bucket? So I don't know. There's probably not a point of going from traditional to voluntary. You're going to want to go from traditional all the way to your Roth. Moving to the voluntary is not going to give you that Roth benefit, and you have to move it twice. So you'll want to go from traditional straight to Roth. Thank you, Yunhee. I'll give you guys a few more minutes for some questions. Question from Martin. Are the voluntary after-tax contributions limited to the 20% of the net profit as a sole proprietor? Great question, Martin. It's not limited to the 20%. So it's 100% of your net earned income, but you just can't, you can't put in more than you're making. So if you're making, $100,000, you can put in all $58,000 to that voluntary after-tax bucket. If you're making $20,000 for your net earned income, you can put all of that into that voluntary after-tax bucket. It's a little confusing, but it's 100% of your net earned income. You just can't go over your max. Great question. Okay, Yunhee, I'm still not understanding then. What is the purpose of the non-Roth after-tax? How do I fund it? So kind of like what we were just talking about with Martin, he can't make any of his employee contributions because he's maxing out at his full-time W-2 job. So that means he can't have any Roth funds, but actually he can because he's utilizing this voluntary after-tax bucket. So, Yunhee, it really just depends on if you want to utilize this for your plan. It's a way of increasing your Roth funds, being able to get $58,000 into that Roth bucket. If you don't have that voluntary after-tax bucket, you can't get those funds over there. So that's what it's for. I hope that provides some clarity. Question from John. Are the bank accounts you're referring to set up in the custodian bank such as Schwab? Great question, John. If you have your trust accounts there at at Schwab, or their pooled accounts. I'm not sure exactly, but it's your solo 401k at Schwab. Yes. So you'll just open up some multiple accounts at Schwab, and you can do everything that we've talked about here. You can do that all within your Schwab accounts. So yes. Yunhee, where would the money come from in order to fund the non-Roth after-tax bucket? All contributions are coming from your net earned income of your business. What you're paying yourself. You can't just throw any money in there. It needs to be backed up. Yunhee has an example. The traditional bucket had to be funded from a rollover from an IRA. So if you have, you did your rollover, it's now in your traditional bucket of your 401k, you can convert that to your Roth. There's no need to utilize the voluntary after-tax bucket there. You're just going to pass over that. If you want to do conversions and you want to turn those traditional funds into Roth, you'll just go from that, your traditional bucket, to the Roth bucket of your 401k. Question from G. Can you make voluntary contributions without making employee contributions? Great question. You could make all your contributions as that voluntary after-tax contributions. If you wanted to throw your full $58,000 into that voluntary bucket, go for it. You actually can't make any more contributions because you've maxed out. So yes, you do not have to make those your employee contributions. Remember, voluntary after-tax contributions are considered employee contributions, but it's not that $19,500 that we were talking about. Thank you, G. Yunhee, so what I'm asking is, where must the money come from in order to fund the non-Roth after-tax bucket? It's coming from your business earnings, Yunhee. And Yunhee, in order to fund the Roth 401k, you must fund it either through a conversion or I guess by contributions. Yes, so new contributions to the Roth bucket. You can convert some of your traditional, those voluntary after-tax, or if you have a 403b, Roth. So if you do have some Roth funds out there that are not Roth IRA, they have to be 457 Roth or 403b Roth. Okay, Yunhee, it sounds like you got it. Awesome. Okay. Oh, I love when you guys chat with each other. Wonderful. Okay. It looks like we have about 2 minutes left. Great questions. I think this was a really fun webinar. If you guys have any ideas for the next webinar, absolutely post it to the network. I want to do things that you guys are interested in. So let us know. If you have additional questions, post them to the network as well. We're happy to go over them. So thank you everyone for participating. This has been great. Thank you for all your questions. And we'll see you either next Wednesday for our next Webinar Wednesday series, or we'll see you on Monday. Don't forget, Monday we have our open questions and answers, and that is at 6 p.m. Eastern time every Monday. So we'll see you next Monday, next Wednesday. Have a fabulous rest of your week. Bye.